Well, debt has a payment stream from day one. Preferred equity does too. But preferred equity, unlike any of those types of debts, also has an upside, meaning they take place in the profit if the asset is sold. However, it is a capped amount of profit.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 423. Over the past year and a half, the unprecedented rise in interest rates has had many ripple effects across the commercial real estate investing world. These ripple effects have put many investments that were made in the past 2 to 3 years in jeopardy. Today, we're going to discuss those ripple effects and some of the solutions that operators are coming up with to address them. And I can think of no better person to help us make sense of this than friend of the show, Paul Moore. You've seen Paul's articles in Bigger Pockets, and he's been on the show many times. Today, Paul is going to talk about preferred equity and how it's being used to bring additional funds into a distressed project. Paul is the founder and managing partner of Wellings Capital and a best-selling author on multifamily and self-storage. Paul, thanks for joining us today.
Brian, what an honor to be back. Thank you.
Thanks for coming back again and talking about preferred equity.
Absolutely.
When we say preferred equity, why don't you tell us what exactly we are even talking about?
Some people might tune out and think, well, yeah, I understand that. I get preferred returns in my syndicated investments, and it's nothing to do with that, except that it shares the word preferred. Preferred equity is a different spot in the capital stack. So, Brian, jump in if you want to add to this, but typically the way I see it is there is senior debt on most projects. And of course, some are acquired for cash, but typically there's senior debt and then there's equity. And that equity can typically be common equity, which is, in my mind, LP equity that's raised from lots of passive investors. And then there's GP equity, which is equity raised by, where the sponsor puts their own skin in the game, and both, or especially the GP part, is critical for most projects.
When you say senior debt, you are talking about the loan from the bank or Fannie Mae or Freddie Mac or whoever the lender is. That's the senior debt, right?
Yeah, the senior debt that expects to get cash flow, interest payments, possibly interest and principal, and it has a lien on the property. It has the first position, expects the lowest ultimate returns, but takes by far the least risk.
And that's the traditional capital stack. You have the senior debt, which usually puts up like 60 to 80% of the purchase price or the acquisition plus costs.
Right. Yeah.
Like you just mentioned, the limited partners and the general partners will bring in the common equity.
Yeah, I would call that common equity. But there's another spot in the capital stack. There's actually a couple more, but it would be in the middle between those. So today we're seeing a situation, Brian, as you referenced, where a lot of lenders are pulling back. They have not only raised their rates, but they've significantly tightened their terms. They've said no to a lot higher percentage of deals. Some aren't lending at all. And so it's much harder to get a loan. And when you do, it's harder to get a high LTV loan to value, or LTC, loan to cost more accurately. And so those lenders that came in before at, let's say, 75% are coming in now at, let's say, 55%. But it's no easier to raise common equity. In fact, it's harder now as well, because let's face it, the herd usually only invests when there's optimism and when things are good. The massive herd of people generally sits on the sidelines or slows down or invests less right now. So you might think that the solution to the 55% loan to cost debt is raise 45% in equity. But it's not that easy. In fact, a lot of folks are still, very fortunate right now to even be able to raise the 25% we talked about in the example. And so now there's a hole or a gap in the capital stack. And the question is what to do. If you want to get your deal across the finish line, you've either got to come up with your own money to do the difference, or you can come up with mezzanine debt, which would be second lien position debt, or preferred equity. And today we're going to be talking about that preferred equity in the middle of the capital stack.
You mentioned mezzanine debt. And I want to make sure we're clear on what that is. Is that the same thing as preferred equity? And if not, what is the difference?
Yeah, no, it's not. It's the same place in the capital stack. And so the mezzanine debt would be debt behind the first loan. It would be a second loan. So if you have a mortgage on your home, let's say you have a $400,000 home with a $250,000 mortgage, you might have a second mortgage or a home equity line behind that of another $50,000, and that would be in the position of mezz debt because it still has a lien, but it's subordinate to the first lien and it's in a higher risk position. And often they also charge, not always, but often you're going to be paying higher interest, especially in times like this. Someone might have locked in a 3.5% mortgage for 30 years, but they might have a home equity line that skyrocketed from 4.5% to 9% now. And anyway, that's a very similar situation to what we're going to be talking about today.
Just to be clear, mezzanine sounds like it's the same as preferred equity then.
Mezzanine has a lien. Sorry, you know what? I need to answer that a little better. So when you're editing this, you're going to want to maybe add what I said earlier to this. Here we go.
Okay.
So while mezz debt has a lien and is able to foreclose, preferred equity is not. It does not have a lien. And it, like equity, it is in a higher risk position. But unlike senior debt or mezz debt, preferred equity has a stake in the upside. So preferred equity might, while debt has a payment stream from day one, preferred equity does too. But preferred equity, unlike any of those types of debts, also has an upside, meaning they take place in the profit if the asset is sold. However, it is a capped amount of profit. So typically when times were normal, or I shouldn't say that, maybe times are normal now. But Brian, 3 years ago, if you got preferred equity, you might be able to get maybe your payment would be 6%, and then you would get an upside of another 5%, so 11% total return. You have less risk, you have payment priority and all kinds of other benefits with preferred equity. But, the mezz debt might have been 7% only, where the preferred equity might be 6 and 5, getting 11% total. But like the home equity line that I mentioned earlier, times are different right now. And we're going to see how preferred equity has changed as well.
Just for our listeners' sake, and just to help keep track, there's two types of investments. You have debt and equity. The mezzanine debt, that's coming from a lender. It's it's either a fixed return or maybe it's a floating interest rate, but it is considered debt. But then preferred equity, that's, even though it might be treated as debt in a sense that it's getting a fixed return, that sounds like it falls more in the equity category.
If you had to find one reason it's equity, not debt, it's because there's no lien. That means there's no right to foreclose.
So, Paul, for those who are watching this on YouTube, and by the way, you can watch all of our episodes on YouTube, you brought a chart with you that we're looking at right now. Can you describe this and what people should be getting out of the chart?
Yeah, so this chart shows the 3-part stack, no mezz debt, but it has senior debt, and this one's showing 60% at the bottom. And the bottom in this case is in the safest risk position, 60% senior debt. And then I'll jump to the top. Typically, in that situation, you would expect common equity to come in at 100 minus 60 or 40%. But in this case, it's 25. 25% common equity, which would include that put in by the sponsor and that put in by the passive investors. And that leaves a gap in the middle of 15%. And in this case, we're filling that gap with preferred equity.
And then on the side there, it says order of repayment and risk profile. So the bottom 60%, the senior debt, it basically has the lowest risk and gets paid first.
Yeah.
The preferred equity has the next level of risk, but gets paid next. And then it's the common equity, or the money that you're raising through syndication from investors or the general partners are putting in. That carries the most risk and gets paid last.
Right. So let's just take a quick example looking at this. If you had a property you acquired for $10 million and you had this exact capital stack on it, you would have borrowed $6 million from the bank or the CMBS lender or whoever. You would have had $1.5 million in preferred equity and $2.5 million in common equity. Now, if something goes south, let's say it's, you've hit the end of the road, it's time to refinance or sell, and you're, for whatever reason, in a position where you have to sell, and that asset has lost 25% in value, which it easily could happen, regardless of what they told you the last decade. It easily could happen. And so now that asset's valued at $7.5 million. Well, the common equity would be completely wiped out. And the preferred equity would have, and the senior debt, by the way, would have been getting payments all along, in theory. And then they would be both made whole at closing because the common equity is acting as a shield in first loss position. You might say, well, why would anybody want to do common equity? Well, common equity also has unlimited upside when things go well. So if the value of this asset doubles, that means with 60% debt and actually 15% equity, I shouldn't have tried to do the math in my head like this, but let's say the value, if the asset doubles in value, your value of your common equity would probably go up, in this case, at least 4x, because, the common equity is, again, in the highest risk, highest potential return position.
So higher risk, higher return for the common equity, the preferred equity, lower risk and kind of capped return.
Yeah, it's capped. And so I'll just jump right into this. In this environment, Brian, we've got preferred equity, especially with small check size. I mentioned 11% as an example earlier. Well, with debt tightening and common equity tightening, people who are trying to get deals done, acquisitions done with preferred equity are often paying something like 9 or 10% out the gate in interest. I won't call them interest payments, but I will call them returns. So it's, predefined contractual cash flow, and then accruing another 5, 6, or 7% on top of that, which is compounded and paid when there's a refinance, a sale, or some other liquidity event. And so that's for example, 15 to 17% total return on a typical value add acquisition. By the way, if it is development pref equity, it might even be higher, even in the 20% range, because obviously there's more risk to the whole project. And if it's rescue capital, which we talked about before the show, and which we can talk about that more later, it could even be much higher because of the high risk of a rescue situation. So, Brian, does that make sense?
It does. You mentioned rescue capital. I think up to this point, what you've been talking about is if you're putting a deal together and you're raising money for the capital stack, this is where preferred equity often fits in. But let's talk about the rescue capital. How is preferred equity being used in rescue capital? And what do you even mean by rescue capital?
So the way I see it, there's 3 or 4 types of uses for pref equity. You might even wonder, why would any sponsor do this? Well, first of all, they want to get a deal across the finish line. Secondly, they can take the preferred equity out pretty quickly because there's usually provisions that allow, a refinance event in, let's say, 2 or 3 years. Or let's say you're a GP or sponsor and you've got another big asset selling soon, or you're going to cash in your Bitcoin or whatever. You can often take out that preferred equity spot. And then you can, own that for yourself as the GP, or you can, if you refinance, everybody in the common equity would get that additional ownership. So it's a big benefit to them as well. Short-term pain for theoretically long-term gain. So like I said, there's probably 3 or 4 applications for this. One is for development. So somebody's doing a subdivision or a multifamily, and I don't have to go through all the issues again, but the bottom line is they need preferred equity for development. Second would be an acquisition, and it usually makes sense if it's value add, because otherwise, if it's a stabilized asset, it's probably too expensive for most people right now. I would sure think so. You can do the math on that. But there's also a value add acquisitions, like I said, and value add acquisitions, again, you're thinking there must be some great upside. And that's where we play most of the time. There's also rescue capital. And that's when a deal's going south. They have to have a big injection of money, let's say a couple $1 million, just as an example, to buy a new rate cap for floating rate debt, or to pay their insurance if they're in places like Texas and Florida and had a massive insurance increase, or if any number of things could cause a rescue situation. And then the last reason I can see somebody would do this would be in a situation of recapitalization. So let's say they've got a mezzanine loan that is, coming due, and the mezz lender is unwilling to refinance it. Now they need to find another source of capital. So, or it could be another reason to do a recapitalization would be they want to buy a new asset. And so we've seen folks who say, I have, if I could pull $10 million out of this $100 million project, I could go buy another asset, and I've got an opportunity right now. So that's recapitalization. We play, and where I know most as, the recapitalization, but especially the value add acquisitions.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
And where does one go to actually acquire preferred equity? I mean, do most lenders offer it? Do you have to go to syndicated groups? I mean, where can you find this preferred equity?
So there are debt and equity brokers out there, and you can Google that. And a lot of them have sources of preferred equity. And that's what I did. About a year ago, we realized the opportunity we see here. And we realized that in the small check size range, $1 to $5 million, there is a huge vacancy because bigger companies aren't going to want to do this. And so we just came in and we went and called about 150 of these debt and equity brokers to try to build a relationship, using the 80-20 or 95-5 rule. We came up with 5 or 10 that were really interested, and we've been working with them. And so they contact us if they have a deal.
Paul, what are the pros and cons then of preferred equity?
Yeah, so let's jump in and talk about some of the pros and cons of preferred equity. So first of all, like I said, there's no lien, but there's much higher potential upside. In fact, a preferred equity sponsor, like we've been doing, there's all kinds of other things that you can get instead of that lien that make it, in my mind, almost as good. Let's just jump into this. So if you're watching, where it says here on my screen, why is preferred equity compelling in general? Number one, it has immediate cash flow. It has future upside and has a shorter hold time. Some people don't want to hold an asset for 10 years, but this might be a 2 or 3 year hold. It's got payment priority ahead of common equity, as I mentioned. It's got lower downside risk exposure than common equity. It still can have depreciation tax benefits. And some people think that's not true, but it's true if you negotiate it, because depreciation can be allocated according to the IRS as the sponsor wishes. You can negotiate control rights in case something goes wrong. So we can actually negotiate management control rights to say, hey, we can come in and tell you what to do or take over, or even we can negotiate forced sale rights before there's a foreclosure. You can also negotiate a MOIC floor. That's a multiple on invested capital floor to potentially increase returns. So here's what I mean. If we're taken out early, let's say in 2 years instead of a 3 years, and the sponsors thinks it's worth it, we can say, hey, look, we were supposed to get 16% a year. We're only going to get 32% because you're taking us out in 2 years. We expected to get 48% in 3 years. So we might have a 45% MOIC floor. Now, you might ask, why is this compelling right now? Why didn't I hear about this the last 10 years? And why is there a limited time window? Well, like I said, a lot of lenders are pulling back compared to what they were doing a year and a half or two ago, because again, lenders always pull back in these times. There's also shortfalls on common equity. The coupon rates as a result are much higher. I mean, when you're paying a mezzanine lender, let's say 9 or 10 or 11%, well, you're going to be paying pref equity even more without a lien. So there's 16 to 8%, 18% coupon rates for these check sizes that are small in the 1 to 7 million range. The higher interest rates we have right now are potentially depressing common equity returns. Think about it. At exactly the time when common equity targeted returns or projected returns come out of the 20% range down to maybe 10% in some cases, you've got a product here that's actually potentially safer for potentially much, much higher returns, though they are limited, like I mentioned. So I think it's a limited time range window because interest rates are going to go down and banks will resume lending like they used to. So I think that this is a limited time window. I don't know what the window is. When interest rates go down, the sponsors won't need this gap funding because not only will they have better loans, but they'll also have more common equity coming in again. When market fear and uncertainty recedes, a lot of institutional investors will also come in, as well as common equity investors, and potentially more competition coming from the $1 to $5 million check size. And what I mean by that is when we started this a year ago, it was almost unheard of with most of these debt and equity brokers to find anybody willing to do a, let's say, $4.5 million check. But now it's caught on. In fact, it's even on Bigger Pockets. There are other folks on Bigger Pockets. There are other people doing this. So you might ask yourself, hey, I like this. Can I do it myself? And the answer is probably not. Number one, most investors don't have, $4 or $5 million to write a check like that. But if they did, most investors would say, hey, I don't want to over concentrate in this one asset. You also, like I said before at the beginning of the show, you can't get these terms subscribing to a regular operator deal. The operators vet preferred equity providers. In other words, we're vetted by the operator to make sure we don't drop the ball at the finish line. And we're already getting a reputation for doing a whole lot of due diligence, but also never dropping the ball at the finish line. There's a significant network we had to develop to source these deals. The due diligence on our part is massive. We even do net operating income audits now on the asset by the, for the seller, we have an audit team go in and audit to make sure the NOI is what we thought. And there's also a 28-point due diligence checklist we follow for every deal. The legal structuring is shocking. And what I mean by that is this. We had a deal recently where there was a $25,000 budget on attorneys drawing up the paperwork, and that was paid by the operator. Think about it. Closing costs. When you do a mortgage, you're going to pay, as a borrower, you're going to pay all the closing costs. Well, same here. Well, in this one case, the legal costs went to more than double that because they kept changing the terms and they kept changing this piece and that piece. And would you believe this, Brian? We actually wired the money to the title company, and then they changed the terms again the day of closing. And we had the money wired back to us after 2 very, very long and intense months of due diligence. We walked away from the deal.
So it can be very complex and expensive to structure these preferred equity deals as well.
It really is. I mean, we're talking forced sale rights, management control rights. We even have operators who say, okay, well, we're not going to give you a lien. Obviously, we didn't expect a lien, but we will sign a personal guarantee. And that's pretty good, especially when they show that they have a substantial net worth and they'll sign a personal guarantee on a deal.
Paul, thanks for explaining preferred equity to us. It's been a good education to understand that, because I hear that term a lot, but I've never quite understood it as well as I understand it now. So thank you very much for sharing this information with us. How would people find out more about you or get a hold of you?
Yeah, they can reach out to me on Twitter at Paul Moore Invest. And they can also reach out to us at our company, wellingscapital.com. And if you would like to get a presentation about preferred equity or a lot of resources, you can just ask, or you can go to wellingscapital.com/resources. And if you don't see what you need there, please reach out.
Thanks again for coming back on the show. Always love having you join us because you share a lot of great information. You're a font of knowledge on so many different aspects of real estate investing. It's been a real pleasure talking with you again today.
Thanks, Brian. Great to see you again.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.